ultimately, there's been a lot of talk about this, some of it good, some of it bad. So, first of all, I think we all know that on July 4th, President Trump signed the One Big Beautiful Bill Act. And this bill is basically modifying the 27 Tax Cuts and Jobs Acts. So some of that is going to stay on like it was in the past. Some is being modified. And we're going to talk a little bit about some of those modifications. The provisions will go into effect January 1st, or I should say between January 1st of 2025 and January 1st of 2026. And when you're thinking about the provisions, let's first talk about the income tax rates and brackets. Now, I'm not gonna put up any charts about where the brackets are, but I'm going to talk about where the changes are going to be coming, where it is coming, and who it's going to be helping. In this case, the income tax rates that are going to change, really the brackets, there's going to be an additional extra inflation adjustment to the lower three brackets, so 22, 12, and 10%. I'm thinking that's more middle class and lower income people, right, Rock? Mm-hmm. So that's where the benefit's going to come. And how is that going to benefit them? Well, as the inflation adjustment is actually going to increase the dollars within each one of these brackets, which keeps more of the money in the lower brackets, less tax for those individuals. So that's a plus up for middle class and the lower income individuals. You look at a limit on itemized deduction. This one actually isn't going to affect anybody but the top income earners. In other words, those in the 37% bracket or higher. And at that level, there's going to be a reduction of the itemized deductions that you have on your returns. So it doesn't really hit the average person. It is going to hit higher income earners. When you look at the gift tax and estate exemption, this one again, this is really going to benefit more of the wealthy. The state and local tax deduction is really going to be applicable only for tax years 2025 and 2029. And what it does is it temporarily increases a limit to the $40,000, which gets reduced by about 30% of the taxpayer's modified adjusted gross income on anybody who has income greater than $250,000 for a single person and $500,000 for married. So you can see here, it's high income earners that are going to get this, their state and local tax deductions reduced. And in some cases, gosh, they're not going to get a whole lot of benefit at all. Now, when you look at the limit on some of the itemized deductions, this again is going to be hitting more high-income earners. So what it's going to do is it's going to reduce the value of all itemized deductions for taxpayers in the 37% bracket or better by approximately 5.4%. You go on to the next one, charitable deductions. Beginning in 2026, the taxpayers who do not itemize their deductions may claim a charitable deduction of $1,000 for singles and $2,000 for married. So if you're one of those that just don't have enough to itemize, but you're still giving to charities, this is actually going to help you and reduce your taxes as well. Qualified business income deduction. This is designed more for small business owners. And the way it works is that the taxpayer may deduct 20% of their qualified business income if they run a partnership, an S-corp, or a sole proprietor. If they're a sole proprietor or any of these other two, you actually have what we call pass-through income, where the money comes directly out of the company and goes on to the individual's 1040 tax returns. They are going to get a benefit. Now, let's look at the alternative minimum tax. Again, if you're a high income earner, that's where the exemption that you get is going to be phased out. So again, this is a bit of a knock for high income people.